Hello. Now we would be discussing some of the issues on export finance, and simultaneously some of the aspects which are being discussed are relevant to imports also. You remember we discussed uniform customs and practices for documentary credits, and we also said there are some documents which are usual and significant. So today we would also be discussing those documents, and of course the focus will be on export finance. They have already discussed the importance of exports to India, right? Therefore the regulator, Reserve Bank of India, is quite keen that a lot of concessions and soft terms are available to the exporters. To begin with, if you take the rate of interest on export finance, it will be definitely lower than domestic finance, because forex that is earned by the country by this export finance is very, very important for the country. So let's now move on to the next slide. Friends, what are all the regulations that are generally involved when we talk about forex, exports or imports? It's equally true. The relevant regulations are: one is RBI guidelines. Now RBI means Reserve Bank of India, of course, that you know, issues guidelines through two departments. One is called Foreign Exchange Department, other is through Department of Banking Operations and Development. Okay. Next, after RBI guidelines comes trade control regulations. Please always remember, when goods move out of the country, naturally the country has to receive payment. Similarly, if payment has been parted with to another country, goods have got to be received. These are two critical aspects. So what does this mean? It means there are two sides to this transaction. One is the goods side and the other is the exchange side. So whenever goods are exported, who handles it? Trade control authorities handle the physical movement of goods, whether it is inward or outward, whether it is import or export. So the trade control authorities control and regulate physical movement of goods and services from India and into India, and that is governed by what is called Foreign Trade Policy 2009-2014. What does it mean? That means items which are permitted, items which are not permitted, some of it could be banned, some of it could be restricted. Now this FTP, Foreign Trade Policy, will take care of the list of goods that cannot be exported or imported, namely banned goods. Next, there are some which the authorities would like to permit on a selective basis. This is called restricted items. All the other items are freely importable and exportable. Then we discussed already this particular aspect. ICC, that is International Chamber of Commerce guidelines, namely UCPDC 600, we have already discussed at length. Then URC, what is URC? Uniform Rules for Collection. Then Export Credit Guarantee Corporation. We will discuss in detail about this subsequently. And last but not the least is FEDI. FEDI we have already talked about in great detail. So these are all some of the regulations which control and monitor the trade movement and exchange movement in the country. Let's move to the next slide. This of course is the time limit for sanction, okay, just for information. Then we move to what are all the types of export finances that are made available. The most common is packing credit as far as pre-shipment is concerned. What does pre-shipment mean? Making goods ready for shipment, right? That could mean processing, producing, manufacturing, grading, sorting. All these things form part of pre-shipment processes or procedures. And once the shipment takes place, comes in the post-shipment stage or the post-shipment finance. So friends, let's understand, export finance can be easily distinguished into two halves with reference to the date of shipment. Please remember, date of shipment is extremely important and sacrosanct in export finance. Now let us come to each stage. pre-shipment stage and pre-shipment finance. How is usually funds given? Finance usually given in the form of packing credit. This is the most common and usual way of financing pre-shipment requirements of the customer, exporter. Next is advance against receivables, and the third is advance against check. These two are not very common, so let's not discuss too much about them. We'll soon be talking about packing credit in detail. And next, let us come to post-shipment finance. After the shipment takes place, you need to provide finance in the form of export bills, purchased, discounted or negotiated. These are the common or usual ways of handling post-shipment finance. There are also other methods: advance against bills sent on collection, advance against exports on consignment, advance against undrawn balances, and advance against duty drawback. These four are relatively less common. Of course, they are there, they are permissible, but it's not so common that you come across these things. So what is really popular is these two. Now let's find out what's the difference between these. What is the difference between purchase and discount? Friends, you are all aware that a bill of exchange usually can be a demand bill of exchange that is payable at site, or usance bill of exchange. There is a usance period involved, due date is involved. Wherever due date is involved, then a bill is discounted. And wherever it's a demand bill or a site bill, where no due date is there, it is purchased. So this is the difference between these two. Next, negotiated. This is a very, very distinct category of export finance. You remember, no? We talked about uniform customs and practices for documentary credit. We also discussed what is called the parties to a letter of credit transaction. You recall that? We have got the issuing banker, we have got the advising banker, we have got the confirming banker, we have got the negotiating banker. Now you will recall what we are trying to discuss. So the route starts from the buyer, LC issuing bank, advising bank, confirming bank, negotiating bank, and the seller. Which means export bills can be negotiated if they are drawn under a letter of credit. Got it? So this is the difference between these two methods of lending. Let's go to the next slide and try to understand some more details. Most important, how do you make a decision whether you would like to finance an exporter or not? See, these are all facilities to the exporters. Let's understand this. How will you make a decision? First of all, it should be a bona fide exporter. That needs no clarification. That's very clear. Next is IEC number allotted by DGFT. Friends, please remember, whether it is facility for importers, let me clarify once again. We will concurrently be covering facilities for exporters and importers because some of them are overlapping. Then we will talk about specific facilities to importers. So coming back to the point, a customer cannot be entertained either for import facility or export facility without this number. IEC means Import Export Code Number. Who is allotting this? Director General of Foreign Trade. Next, we talked about LC. You remember, no? We mentioned export bills negotiated. What does it mean? LC documents are usually negotiated or they are taken up for negotiation. So what does this mean? Please understand that the exporter either goes for confirmed orders for making the exports or goes by an LC for performing the exports. Wherever LCs are involved, then it becomes LC financing, and where it is only export order but no LC is available, it's called firm export order. Firm because unless the order is confirmed, unless it's a confirmed order, there is a risk that the order may not be transacted properly. Next, your exporter who needs the facility has to have the capacity to export. Very important. Then commodity should be permissible for export. You remember, no? When we talked about FTP, that is foreign trade policy, we said goods could be banned, restricted or freely permissible. So goods have to be permissible for export. And this is something very unique. Exporter should not be under caution list of ECGC or Reserve Bank of India. About ECGC scheme we shall talk in detail later, but then let's understand that ECGC, namely Export Credit Guarantee Corporation, has got what is called a caution list called specific approval list. What does this mean? This means I cannot go for export financing without getting into this list and getting the approval of ECGC for financing. This is something like a caution list. The exporter has not performed properly, or there are some overdues, or there is some non-performance. So all these exporters are put under SAL, as it is called. And Reserve Bank of India also has a list of willful defaulters, and the compilation of these two becomes a caution list, and therefore we look at the caution list before going for export finance. Look at this. What is the quantum of advance that could be given to exporter for pre-shipment? That is to enable the goods to be ready for shipment. It should be not exceeding FOB value. This is a technical point. FOB is meant by free on board. This is a method of assessing the value of finance required for a pre-shipment exporter. Then margin may be stipulated. Margin is the exporter has to bring in some contribution and bank finance will be for the remaining portion. Okay? Now let's come to what we mean by pre-shipment. I have already told you in brief. Now let us come to the details. Advance or loan for any other credit granted to an exporter for financing, purchase, processing, manufacturing, packing of goods prior to shipment. What does it mean? That means, let us take for example a high-end apparel, textile or garment that is being exported. So now that will involve procurement of raw material, that is cloth, then putting it through stitching, finishing, and then making it ready for shipment, right? So the first one is purchase of cloth, second is processing or manufacturing, then comes to packing of goods, because nowadays packaging has become a very, very critical point of selling. Therefore, packing of goods prior to shipment. Okay, please read this. Okay. Now what it means is that prior lodgement of LCs or export orders could be waived. That is to say, the exporter could furnish these documents subsequently also. That's what this line means. Shall we go to the next point? This is significant for both import and export. That is to say, whether you are giving facility to an exporter or an importer, this list has become very, very important. Draft or bill of exchange. Let's spend a few minutes on understanding what's a bill of exchange. When a seller sends goods to the buyer, there is a financial element involved in this, that is the sale price. Now, on what basis will the seller claim the amount from the buyer on the due date? This is where a bill of exchange or a draft comes into the picture. When a bill of exchange is drawn, it gives a specific order or instruction to the buyer to pay a specific amount of money on a particular date or on site. This is what a bill of exchange really means. It's an unconditional order on the buyer, who is also called the drawee. On the due date or on presentment, the drawee is supposed to, or the buyer is supposed to make payment. That is what a bill of exchange means. Next, commercial invoice. The invoice proves the contract of purchase and sale, and this becomes the most critical underlying document for the subsequent transactions. Next, transport documents. Bill of lading, that's BL. Bill of lading is a document of title to goods where goods are sent by a ship. Okay. Next, airway bill. When goods are sent by air, then the transport document is called airway bill. Next is railway receipt. This is where part of the movement of goods is in domestic area. I'll give you an example. Goods are exported from Nashik to say Germany. Nashik to Bombay, the goods have to come. How will they come? They will come either by railway receipt, or LR, that is lorry receipt. And from Mumbai port, the goods are sent by ship to the destination. Next, packing list. This is a summary of goods that have been packed. Then this is certificate of origin, a very important document. This is issued by the country where which the goods have originated. You got it? Suppose textile is manufactured in India, India becomes the originating country. Now, Chamber of Commerce in India will give the certificate of origin. This is to indicate where the goods have originated from. Okay? Next, insurance policy. This is of course very important from the risk coverage point of view. So, insurance policy certificate takes care of perils on the sea due to which there could be a loss or damage to the goods. Then, inspection and analysis certificate, this is part of the document. Then, most critical document, last but not the least, it is declaration form. What is this? This is an export declaration form where the exporter declares that this is the value of goods, this is the quantum of goods, this is the ship or vessel name and date of shipment. That is a physical movement of goods. This is a very, very critical document because this has got two angles I already told you about. One is the forex angle and the other is the movement of goods angle. Now therefore, two authorities govern this. What are the two authorities? One is the Trade Control Authority who takes care of the physical movement, and Exchange Control Authority, that is Reserve Bank of India. Next, this is okay. This is how we disburse in packing credit. Just have a look at it, then we will move to the next one. Friends, I have already told you that the interest on packing credit, because of the unique nature and importance of exports, is always at a concessional rate. This will be definitely lower than the domestic interest rates. Now let us look at this important point. 270 days is the cutoff date for the purpose of interest concessions. Okay? Now let's move next. Banks to decide period for which advance. So that means banks have been delegated the authority to decide the period. But look at this very, very important point. If the packing credit is not adjusted within 360 days, then it ceases to qualify for interest. 360 days is the cutoff. If there is a delay beyond 360 days, it ceases to be treated as an export document and export finance. So this is very important. Then Reserve Bank of India, to encourage export finance, refinances banks to the extent of the export finance made, and there for a period up to 180 days finance, Reserve Bank of India provides refinance. If the period is going to exceed 180 days, let's say 270 days, in that case for the 90 days period no refinance is available. Is it clear? Just for information, how it's to be disbursed. Important point is that generally each disbursement, each packing credit is a separate account. Why? Because when realization of the export proceeds takes place, the realization can be matched to the order or LC which has originated the export transaction. Okay? Of course, this is important, end use of funds. That's because interest on export finance is concessional. A customer should not misuse the facility, and therefore end use of funds is very important and necessary to monitor progress made with the exporters in timely fulfilled from the export order, because unless the export orders are fulfilled, neither the exporter gains nor does the country gain. Next, there is something important. Packing credits can be liquidated or paid off in different methods. First method is when the bills drawn under the order or the LC are realized. Okay, that is what is meant by proceeds of bills. Then converting pre-shipment credit into post-shipment credit. That is to say, packing credit shipment has taken place. That is, the date of shipment is over, shipment has taken place. Thereafter, the customer exporter tenders the export documents. We already saw the list of documents, right? So the exporter tenders these documents to the bank. Now the bank has the option of purchasing, discounting, or negotiating the bill. This is called post-shipment finance, as we already saw. This post-shipment finance will replace or will liquidate the pre-shipment amount. Now, there is another possibility. Exchange earners foreign currency accountant. See, whoever is able to earn exchange, foreign exchange, either through remittances or through exports, they could keep a portion of the export earnings in what is called EFC account and use it for meeting forex commitments. But now there are a lot of restrictions going on and these keep changing from time to time. So let's understand the concept. Concept is an export earner or exchange earner is entitled to park it for the time being in EFC account. Now, next is recovery process to the extent of exports have already taken place. That is to say, some exports have taken place. Now the resources which have arisen from that export can also be used to pay off the packing credit. Then, if it is not happening, then banks can decide the rate of interest. Concession will not be available.